This is Greg Dunweiler, and you are listening to another episode of the Dividend Mailbox, a monthly podcast about dividend growth. Our goal is to stuff your mailbox full of dividend checks. When they grow over time, a funny thing happens. You create wealth. Welcome to episode 56 of the Dividend Mailbox. Looking at the start of the year, and now we're on episode 2 for 2026. It has been a phenomenal start for us. It is a complete 180-degree turn from last year. We're doing much better than the market. We've already had multiple dividend increases, and the total return of our portfolio has played a big catch-up for what we lagged last year. So one of the great things about being disciplined and staying with your strategy and not switching horses is when it turns, it can turn really fast. And that's sort of what we have seen in the last month and a half. But in this episode, we're going to approach it from a little different angle, and that is sometimes success has problems of its own. As you continue to deploy the strategy, some of these prices have moved fairly aggressively. If you're putting new money in it, the yields have declined for what you're paying for something now, and it also makes the total return looking out 10 years a little bit more challenging. So what's happened in the last 5 weeks has maybe nothing to do with how the year will go. But today we're going to talk about income versus total return, cash flow, looking at it as an anchor, and just walk through some real portfolio examples that we've experienced here lately to give you an illustration of when to sell, when to hold, when to buy, and how we define success as we continue to evolve with our portfolio. Just as a quick note before we get into this, dividend growth investing sounds simple, but doing it well over long periods of time takes discipline and patience. These episodes give you pieces of how we think about it. But if you're trying to build wealth, it helps to have a clear framework you can come back to when things get uncomfortable, which is why we wrote Dividend Growth, the Quiet Engine of Wealth. And ultimately, the real goal of it is to help you tune out the noise and make better long-term investment decisions. So if that interests you and you'd like a free copy, you can find it in the show notes or at growmydollar.com/dividend-growth-book. With that, let's get into the episode. For those of you who listen on at least a somewhat regular basis, and especially in the last few episodes, you are quite aware that the S&P 500 had a great year last year. It was up almost 18%. The dividend space was up in anywhere from the mid to higher single digits. It lagged pretty substantially last year. As we have stated in the past, part of our mandate is income. However, total return is, in the end, extremely important. Last year, our income, we were up 8.7%. In the S&P 500, that dividend grew by 5.5%. So from an income growth standpoint, and part of what this whole podcast is about, we're going to define that as success. The total return, totally different picture. And like pretty much all the dividend indexes, we were up single digits. But the fact that our income had been growing pretty much exactly as we had hoped, in fact, doing a little bit better, and it was doing better than the S&P 500, that's how you get these big gaps that close fast. as we move into this year, it's like the whole world changed. All of a sudden, growth became a big question mark. What's going to happen with AI? Is it overbuilt? Too much money going into it? Can it continue to perform? Questions started to arise, and the S&P 500 for the month of January was up 1.45%, which I tell you on an annualized basis is actually still pretty good. I mean, it's more than 12% a year. So that is still attractive, but guess what changed? And it changed dramatically. It's the dividend space has kind of taken off, and money that has come out of tech has gone into the dividend space. S&P Global tracks, a whole page full of different indexes, and they have about 5 different dividend-oriented indexes that they track. And the S&P High Yield Dividend Aristocrats was 6.8% last month. For January, U.S. Select Dividend was 6.6. Dividend Aristocrats is 5.7. Low volatility, high dividend, 5.25%. And if you look at last year, all of those dividend indexes all lagged considerably. In our model portfolio, which for those of you who don't listen all the time, I will just quickly remind everyone, this is a live portfolio. It has been going since August 2010. For the month of January, it was up 8.2%. Year to date is up about 14%. So even the last week has been very good to us. Really what's happened is we've played catch up. In fact, we've had such a strong year that on a long-term basis on our model portfolio, it's almost caught up with total return for the last 15 years up to what the S&P 500 is doing. And, here's one of the big keys. So we lagged the market last year, but the income did not. And guess what? None of that income money was taken away from us. In fact, we've had 3 companies that have increased their dividends in the last few weeks. The income growth strategy is alive and well and continues to work. And since August of 2010, our income growth is beating what the S&P 500 has grown by, which is about 8% a year. Our income is up close to 10. So we've actually beat our hurdle rate of 7%. That creates value over time, and they can't take that income away from you. Can they take a stock that's gone up by 300%? Well, we've seen some of those unwind here recently as the market has really shifted. And when you have a big growth stock that gives up a big chunk of growth, either it's got to grow back into it, the market's got to get back to a mindset that they want to pay up for it again, or it's going to take years for earnings over time to catch up. And then sometimes they never do. So what this is a strategy that you really have to, be committed to, and you have to understand why you're doing it and what drives it, because when things change, they can change fast. And then one of the takeaways that I hope people get from this, and it really helped us last year, is you don't have to focus everything on price appreciation. If you're growing your income by 7% a year, over time, good things happen to you. And then you push that out a couple of decades, it creates a lifestyle, and it's also predictable, and it holds up through pretty much any market cycle. And then it just doesn't force you to worry so much about chasing whatever is currently working. The part that most people don't talk about, and that is the downside of success, because success creates a different kind of problem. And how we're going to define that is when prices have moved up, and especially when they moved up fast and earnings don't have a chance to maybe catch up in the last several quarters, then it feels good. But the problem you have then is when you're trying to buy something at a reasonable valuation, those opportunities begin to disappear. And I really try hard not to overuse Warren Buffett, but, his principles are pretty solid. One of his famous saying is, the great thing about investing is they don't call strikes. You can let the ball go by right in the middle of the strike zone 20 times. All you have to do is hit one of them. From our standpoint, here's the mindset. Sometimes the best move is to do nothing. And in our case, one of the challenges can be, okay, so the market's moved up. The income growth is still there because price in and of itself doesn't affect that. But total return, if we pay too much, you've used part of your income to offset where the stock price has not moved as much or actually has gone down. So it's just a matter of being patient and waiting. That's part of the discipline of this whole strategy, which really brings to the point, okay, exactly how do you want to define success? If all we cared about was income, well, if we liquidated the entire portfolio and bought 10-year Treasuries and we got 4% for the next 10 years, I can actually take all the risk out and I can get this income up right now. But here is the problem. Number one, 4% on your Treasury yield, it's not going to move. It's not going up. It's not going down. But the bigger issue is we have no real assurance or predictability that we're going to get the total return and the total income that we want over time. Because if rates were to take a big dive down, then you potentially have a bigger problem. For us, that's not success because we're not buying this stuff just to get a dividend. We're buying it to get a total return, and total return, a big piece of it is driven by what you pay and then ultimately what you potentially are going to sell it for. So when you are looking at cash flow and that kind of becomes your North Star, if the cash flow continues to come in, again, we feel cash flow solves all issues or all challenges eventually. And I just finished reading a book, Money Changes Everything, How Finance Made Civilization Possible. It's a fascinating book if you're interested in the history of finance. One of the theories is that actually language was developed to record financial transactions. And one of the things that comes up in this book, there was a company in, I believe it was 1158, that was started. Several investors came together. They built a mill on a river in Europe. What did they do? They distributed the profits out to the different stakeholders, i.e., basically it was a dividend. Dividends actually go back hundreds of years. So they've been around for a long time. And in the end, what does everybody want at some point, even if you own the hottest growth stock, at some point, that company has to show that they have the ability to generate cash flow or, what's it worth? There are a few things like gold and art and, collector cars, but as a rule, most assets, and especially a company, nobody collects a company because it has a great name or it's in a certain location. The bottom line is everybody thinks at some point they can monetize that asset. In the end, it's all about cash flow. And in the last month, what's happened is the market has been less concerned with growth and they go back to the old reliable cash flow. So now we're gonna continue on and move into the parts that'll kind of illustrate success and its challenges. And what I'm going to do is look at something that was sold, something we hold, something that we are buying, and how does that fit in with how we define success. Try to give you an idea of how we make decisions as far as how to apply this whole dividend growth concept. I will start with one that was a success, and we sold it last year. We sold it in May of 2025. It was Emerson Electric. It was one of our first dividend growth investments in our portfolio. We did earn about a double on it over the time that we held it. We sold it at about $120. And as of now, Emerson Electric actually hit a high just in the last several days of in the high 150 area, which is considerably higher than our 120. So you would say, well, that decision didn't work out so well. Can you say this was success? Should we have held on? Is there regret here? Well, here's where I'm going to go back to. If you're looking at total return and you're looking at what your end game that you're trying to achieve, we want that growing income stream. They were really slow to do anything with dividends. They were only doing a half a penny or a penny a quarter for the last several years. They did start to pick up a little bit. Their dividend bumped 5% last year. But when we sold the stock, the yield on it had dropped below 2%. And we were not seeing a whole lot of clarity. Right now, it's got a dividend yield of about little over 1.5%. Their earnings in the last 12 months actually declined slightly. Revenue is just barely up from last year. You go back to 2019, revenue is actually down slightly. Operating margin actually has improved. But if you don't remember the story, Emerson has gone through a pretty major transition here in the last several years. They've sold off some more core manufacturing type things and gone into more data collection, more software type businesses, and therefore margins have improved. However, the flip side to that and the downside of acquisitions, which we don't like as a rule, if you look at return on invested capital back in December of 19, it was 15%. You go back historically, it has been above 10% for the most part. And that was one of the reasons why we originally owned it. It was a very well-managed, profitable company, but you get to 12/24, it had dropped to 5.5%. If you get to last year through December 25, it was up to the big number of 6.5%. So what you've got, this is a typical thing that you should pay attention to. These acquisitions, a lot of times, they can improve earnings. It can improve margins depending on, businesses that they're moving out of and into, but it usually comes at the cost of the shareholders in return on capital because they have to buy these earning streams. And if they have any kind of a favorable outlook, they're not cheap, and it shows up in return on invested capital. The earnings that they have not matched how much capital they put into these new businesses. So it tends to imply that this company is going to take a while to improve the return on their assets. And it's a red flag that they're going to have sustainable dividend growth of any significance, because part of what they have to do is pay down debt to where it earns its cost of capital or better or long term. I'm not saying it can't, but it's hard to generate shareholder wealth. So that's Emerson. It's potentially set up to be a disappointment here at some point. And I have no regrets of selling this thing because it really doesn't fit our model anymore. We can't really see where we're going to be able to double our money on this thing in the next 10 years. And that's part of how we decide what success looks like and what we're after, what our intentions are. The next one I'm going to go over, and we're kind of going up the scale here on from more problems to less problems to what we think is good. We're going to hit Clorox. We've talked about Clorox several times in the past, and you can go back to past podcasts if you want to listen to it in much more detail. It's another great illustration of be careful with success, what you ask for, because management has done a great job long term. This thing was a real wealth creating machine up until they hit 2020. The short version is, the business just spiked because guess what? Everybody wanted everything clean. So their business just went through the roof. They had problems managing that growth. And then once that whole story died down, they're stuck with all this residual inventory, et cetera, et cetera. It was a great story when we first went into it. We were looking to somewhat reversion of the mean. But here we go. We are now 5 years plus past 2020. And we actually thought about selling it a few weeks ago. Their earnings in 2025 were $6.12. You go back to 2019, even before 2020, they were $6.36. So over that 6-year period, earnings have not grown. In the end, you got to have a growth company to have a growth dividend story. And they seem to be struggling with it. Revenue in 2025 was $6.7 billion. In 2024, it was slightly over $7 billion. 2019, it was $6.1 billion. So, this company hasn't grown a whole lot. Their operating margins, right now, they're 16.6%. In 2019, they were just under 18%. So they've declined a little bit. It is a 4.1% dividend yield right now because they have bumped the dividend, and then they have also, the stock's come down. So, 4% is pretty attractive dividend, and it is a very established brand business. Our view is if you have a higher dividend yield, you don't have to have quite as much growth to help still get the compounding return that we want of 7% long term. But the dividend in 12/19 was $1.06. Right now it's $1.24. So, the growth has slowed down considerably. We bought this as a reversion to the mean. It struggled. And what do you do with it? This is where it starts to get more complicated. In 2025, their return on invested capital was 24%. In 2019, it was 24%. Same number. The profitability of the business and their asset base is pretty good. One could potentially argue that, okay, the core business is still very profitable. Can they get this thing back growing again? It's paying me 4% while I wait. Give them the benefit of the doubt. Well, what happens a lot of times? Companies go out and try and acquire growth. Lo and behold, they announced just, a month or so ago that they're buying a private company called Gojo. Probably potentially know it for their hand cleaning Purell product that they're kind of famous for. They're buying a similar business as to what they have. They're paying $1.9 billion after the tax benefits. And according to their press release, they have about $800 million in sales. They do not tell you what the profitability of it is, but they think that for the next 3 years, it's probably got a 5% annual growth rate, which is a little better than what Clorox has been doing. So we can do a little back of the envelope here, and we can say, well, really the star performer in this segment is Procter & Gamble. Their net income is 19% of revenue. If Gojo actually earned 19% of their $800 million in revenue, that's $152 million of net income. Divide that by what they're paying, $1.9 billion. That's an 8% yield is what they bought it at. That's okay. Not great, but it's reasonable. Gives them something to do and, something to work with. And if they get 5% growth out of it, helps the business a little bit. But what if it's like Colgate-Palmolive? Their net income is 11%. If they earn 11% of 800 million, now it's 88 million. That's a 4.6% yield on what they paid for it. That is not so attractive. And they're going to have to finance this transaction with more debt because they don't have near that enough cash to pay 1.9 billion. At the end of 2025, they had 2.8 billion in debt. Right now, they have times interest earned of 10 times. If they drop down to 4 to 8 times, which is quite likely going to happen after this acquisition, just speculating here, then they go down to triple B. Triple B credit right now runs at about a 5% yield. So right there, unless they're really going to count on saving, synergy, and what they can do with that business, it's kind of a break even on what the debt is going to cost them and potentially what they paid for Gojo. So that's kind of the red flag where if they go through with this acquisition, they're going to be focused on paying down debt, and we don't see any real clarity to how this thing potentially is going to raise the dividend going forward. It's going to be really small bumps for a while. When they announced this acquisition, it was kind of a letdown from our standpoint, but investing is far from a perfect science. At the time, the stock was around 105. Lo and behold, it hits 125 today. The stock has done really well in the last few weeks. Part of that, I think, is just because of the whole dividend space has been on fire. But kind of watching this one. Clorox has been a very dependable, predictable business up until, 2020 really kind of messed with them because they were the very definition of the beneficiary of all the stuff that went on in 2020, but it left some residual problems that they continue to work through. They've never really been tested until the last several years. So now, you've got management that's looking for growth, and you got to be careful with the things they do. Now I'm going to move on to, here's a better story. Our friend Hershey. Hershey's been doing really well. The stock is up to around $230. We bought it considerably lower than this. It had more than a 3% dividend yield when we purchased it. Now, because the stock's up, the yield's down to 2.5% for anybody that's buying it today. Personally, at this price, I wouldn't go into it, but it's one we're definitely going to hold because it's a dividend growth story. And there again, we did a whole podcast on it. Cocoa prices went through the roof about 2 years ago. I mean, we're talking like up 3 to 4 times what they normally have traded at. So part of the story of why we bought it was, there's an old saying with commodities, the best cure for high prices is high prices, because when you have really high prices, then producers tend to start coming in and planting more, or you'll get potentially more cocoa farmers. The cocoa story is a little more complicated because it's kind of a niche crop, and it's restricted to just certain areas. But that was our general thesis, is that, hey, cocoa is probably going to come down. And lo and behold, it did finally start to come down. If you look at December of 2025, earnings were $4.36. A year ago in 2024, they were $10.93. So a big decline. And if you go back to 2019, and I always like to use before 2020 numbers because 2020 screwed everything up, either good or bad. They were $5.49. So earnings are still down a little bit from 6 years ago. They're down a lot from 2024. I have to tell you, my observation of that, the fact that they were profitable and profitable to a reasonable degree in the kind of environment they've been through, I think tells you how strong Hershey management is. Part of that came through hedging of cocoa, but I think it's a real testament to how well the company is run. And what you've got is a situation as cocoa continues to come down, a real chance for some excellent earnings recovery. If you look at revenue, even though the cost of chocolate went up, revenue was $11.7 billion last year. The year before, $11.2 billion. Back in 2019, it was $8 billion. So they've been able to continue to grow revenue, even though they raised prices. Operating income, I mean, that story is probably somewhat obvious. They had a 22% operating margin back in 2024. Last year, it was 16%. In 2019, it was 21%. Return on invested capital, they usually are up around 20%. In 2024, it was 22%. In 2025, it was 8.5%. So, as cocoa comes down, it just seems like Hershey's in a great position. And the dividend a year ago, it was $1.37. Currently, it's $1.45. In 2020, it was 77 cents. So it's been a great dividend story, and they have been committed to dividend growth, even with the challenge they've had in the business in the last few years. This one, we're hanging on because even though not real excited about wouldn't put new money in it at the moment, we are confident we're going to get the dividend growth. So therefore, this one, we just pretty much step back and right now it's on autopilot. If anything, if the stock moves up, very much more, we may start to look at paring a little of it back, but we're not at that point yet. The last one I'm going to touch on, this is probably the favorite pick at the moment, but it's always dangerous to say something is your favorite pick because inevitably it either doesn't work or what do you know that the market doesn't know, and et cetera, et cetera. Best pick does not mean you go out and sell everything and put it all into that. But it would have to be right now Accenture. And reason why we like it, dividend yield is about 3%, which is our sweet spot. They've been growing it at 10% a year. The return on invested capital is 20% currently. Operating margins, they've been steady. The dividend payout ratio is 50%, but they have very little debt, so there's not too much risk to that. Earnings are currently $12. The estimates are $16 in 2.5 years. If you've got 50% of $16 in 2.5 years, that's an $8 dividend, which is up from $6.52 right now. And that is your 7% dividend growth. This used to be a pretty high growth company. It used to trade at a PE above 30. It is now below 20. One of the things that's happened, this is an AI story. You should go back and look at our past podcasts. We think AI is going to help them because we'll just use Clorox as an example. They can have some employees look at AI and how they can use it in manufacturing, but they've got distribution, they got marketing, sales, they've got inventory control. Accenture is one of the few companies, and especially on a global basis, that can go into Clorox and take all these different divisions and put them all as one unit, use the different databases, mine them for useful information out of each of the divisions. You're not going to have an employee of Clorox that it's going to be pretty rare that they're going to be able to put that complicated of a puzzle together. That is going to be Accenture's sweet spot. So we think AI can even be at some point a big positive for them. And right now, the market's not sure what to think of it. And when there is uncertainty, stocks tend to go down. And that's what's happened to Accenture. For us, it's not too hard to connect the dots to a 10-year number that should at least be a double from here. We feel relatively good that we're going to get the dividend growth. We're going to get the total return growth. We don't have to have PE expansion, but it's cheap enough that that's going to be possible. So therefore, in our mind, you can continue to buy Accenture, and the lower it goes, the more we'll add to it. So, with all that, the point of this podcast is sometimes success can, in one manner, become your enemy because it gets harder to redeploy the capital. However, you got to be patient. And I will say this, in the end, it gives you more options when you have higher prices because you can start to take something off that has done well, that has a much lower yield, and turn around. That's what we did with Emerson Electric. You turn around and buy Accenture. You basically take your income up 50% on one shot. And then Accenture, they grew the dividend 10% last year. It's got the dividend growth story. Emerson Electric has not. So with that, I would like to go back to what does success look like? And, right now you could say, well, we should be jumping up and down and having parties. But I will tell you, for us, ultimately, we want that growing income stream. We had it last year. So we had a pretty strong version of success, but it wasn't the total package, which is total return. But you have to have a belief system and you have to have patience because you're going to have times when the market is just not where you want it to be and they're not really looking at where you think value is. They're somewhere else. And that's exactly what happened to us. And it's the challenge for every investor, depending on what they're trying to achieve, is to maintain your discipline and not to get sidetracked. It would have been real easy last year to say, let's put a little more growth in here. Fortunately, we stuck to our discipline. And this is usually true for whether you're a tech investor, a growth investor, value, dividend growth, high dividend, no matter what you're doing. Probably the biggest key to long-term success is staying consistent, because when you switch horses, you go from growth to value or go to dividend yield now because it's doing well, that tends to lead to problems. The beautiful thing about cash flow is, in a growing income stream that you get paid, is that sooner or later, the market usually rewards you for it. We may, over time, beat the S&P 500. We may lag it a little bit. We may match it. In our book, we just assume that with that growing cash flow, prices will take care of themselves. If you enjoyed today's podcast, please leave us a review and subscribe. If you would like more information regarding dividend growth or our investment strategy, please visit growmydollar.com. There you will find previous episodes and also our monthly newsletter. If you have any questions or anything to add to today's episode, please email Ethan, ETHAN, at growmydollar.com. Past performance does not guarantee future results. Every investor should consider whether an investment strategy is right for them and all the risk involved. Stocks, including dividend stocks, are volatile and can lose money. Dunweiler Capital Management may or may not have positions in the publicly traded companies mentioned herein.
Hey there, listeners. If you enjoy this podcast even half as much as we enjoy producing it, show your support by subscribing and leaving a review. It really helps us keep those dividend checks coming.